In this video, I'm going to be explaining the Asian session liquidity combined with the break and retest strategy. Now, the break and retest strategy, as we know, is a very popular trading strategy, and a lot of people don't really know how to use it. And there are various ways of using this strategy, but in this video, we're going to be talking about how to use it with the Asian session liquidity. I'm going to be showing you how to apply this with the Asian session liquidity. If that sounds interesting, let's get into it. Let's go. If you trade and understand market manipulation, you know that you will know that we trade patterns. We don't trade guesses or gamblings or stuff like that. We trade certain patterns that repeat themselves over and over again. Now I'm going to be showing you the pattern that you're going to be using when trading the Asian session liquidity with the break and retest. And these patterns usually repeat themselves a lot. So if you can spot it, if you can train your eyes to spot it, then you'll be good at it. The more time you spend on the screen looking for these patterns, the better you would be at spotting them on the live market. So now, to break down the strategy, I need to first break down the Asian session liquidity so you can know why the pattern exists. So we know that this is the Asian range. So this is our Asian range here that lasts for 8 hours, and we know that the market usually consolidates during this period, during this Asian session. So now what happens is this consolidation during this consolidation and after this consolidation, there's usually liquidity located at the top and at the bottom of the Asian range. Why? Because market makers are accumulating contracts, accumulating positions, right? So people are selling and buying. So their stop losses and stop losses are above and below this range, right? So that means there's liquidity above and below. So what happens is the market then goes up or goes down. In this example, goes up and clears out the liquidity that is located here, right? And then market goes back down. So when the market goes up, what happens is it does two things. It clears out the liquidity and also induces people to take buys, right? So people begin to buy in here, right? As people begin to buy in here, they also create liquidity here like this. So what happens is the market goes down, takes out those people that bought, and also it induces people to sell, right? So people begin to sell again, expecting to take this back down. Then the market goes back up, takes those ones out, and then eventually goes down like this. So now what you're going to be looking for is, let me just draw this back. So this is our Asian range. The market consolidates in here, breaks to the upside, gives you this M formation like this, right? So what happens is the market then, after taking out the liquidity located here and forming this M formation, fails to break this high. Sometimes it might throw a wick above, or it might break it and enter back. Right? You can have something like this, or you can have something like this, or you can have something like this. These are just different variations of the same pattern. Right? So this is the standard pattern, equal highs. So, or you can have a wick to take out the the stop losses located here, liquidity located at the top. So when you get this, what you're going to be looking for is you're going to be looking for the market to break the neckline of the M formation, right? So once the market breaks the neckline of the M formation, what you're going to be looking for is for the market to come back and retest this area, this zone, right? And then continue down. So when this happens, you're going to be looking for a sell entry somewhere here. You're going to be looking for a sell entry somewhere there, and then your stop loss can be 10 pips above the structure, above the pullback, right? So this M formation confirms that the market is about to go down. Market makers have finished trapping the people who bought all in here, right? So market makers have trapped people in this area here, in this block here, and then shifted out and came back for a pullback, and then you enter here, put your stop losses here, and then the market continues down. Now the same thing also happens for the W formation. So you have your Asian range here, you have your consolidation, break to the downside, take out the liquidity at the bottom side, right? And then market goes up, comes back down, gives you your W formation, and then goes up and breaks the neckline, right? So now what are we looking for? We're looking for the market to go back to this neckline and test the neckline and then continue up like this. So you're going to be looking for an entry in here inside this area like this, right? And your entries will usually be rejecting candles like hammers, inverted hammers, railroad tracks, engulfing candles, star formation, morning star, evening stars, right? Those rejection candlestick patterns. So you will see the rejection. The candle will go all the way here and reject, and the market will go all the way here and reject. And once you see the rejection, you can take the opposite color of the candles. For example, if you want to sell, you enter on the red candle here, and if you want to buy, you enter on a green candle all the way in here, right? So I'm going to be showing you how to draw, because there's something that you're going to have to see here. In order to draw your box, you have to draw a box. It's not just a line. So I'm going to be explaining that right now. So when you look at the candles, right? When you look at the candles, you know that the candle has a body and has a wick, or as people call it, shadow, right? Like this, right? So this is your candle, and you also have a red. This is a bullish candle, and then this is a bearish candle. Let me just draw this out to signify the bearish candle. So this is your bullish candle and your bearish candle. Now, what you're going to do is, if it's a bearish candle, you're going to draw your box. You're going to draw a box, right, from the close of the candle all the way to the wick, to the end of the wick or the shadow, like this, right? So this is how you're going to draw your box. You can draw it like this too. The same way you draw it there, you also draw it for the bullish candle, right? So you draw it like this, right? So you're gonna see the candle, this candle, you're gonna see it on the neckline. So for example, let's say you have your Asian range, you have your breakout, you have your M formation like this, right? So coming into, when they are forming the M formation, sorry about that, let me see. When they are forming the M formation like this, you're gonna have a candle here that is gonna have a wick at the bottom, or at the bottom side. You're going to be looking at the bottom side wick if it's an M formation, right? So then the market is going to go back up, right, and give you this M formation. So you're going to be looking for the market to break below the wick, not just the close of the candle, below the wick. And when the market breaks this wick, that's your break of structure, right, as people call it, right? And then you're going to have to draw a box from the close of the candle, or from the open of the candle. This is a bearish, this is a bullish candle. So from the close of the candle, from the open of the candle, I'm going to draw a box and extend that box out like this. All right, so this is going to be this box is going to be called your liquidity box. Now, when the market goes back to this box, to this zone, you can also call it a liquidity zone, or liquidity box, anyone you want to call it. All right, when the market goes back there, you're going to look for rejecting candles, maybe hammers or something that rejects, and then you simply enter all the way in here, right? Same thing goes for the W formation. Whatever happens for the M also happens for the W. Now this color doesn't, the color of this candle isn't relevant. This can be a red candle. This can also be a bullish candle. Anyone that it forms, what is important is the box that you draw from the from the end of the body to the end of the wick. Right, so you extend that box and wait for the market to go back to that box and reject. That's your break and retest. Now I'm going to show you a couple of examples on the charts, just for more clarity. So let's get into the charts. So here we have a couple of examples, right? So here you can see that we have our Asian range here, right? Our Asian range is about 16 pips, which is good. So we have our Asian range. The market consolidates in this Asian range, and what happens? The market breaks to the downside and gives us this W formation down here. Now what happens? The market goes up and breaks the neckline, right? So what do you do? You draw your box from the close of the candle, extend that box out like this, right? And then you wait for the market to come back and retest that box, that zone, that liquidity zone. So what happens? The market goes all the way up and then comes back down, retest the zone here and rejects it. This is a inverted hammer, also almost looks like a railroad track, but this is an inverted hammer. You can see this pin to the lows here, right? So your entry will be here. Just enter here, put your stop loss maybe here, or 10 pips below the zone, maybe 10 pips below, right? And then ride this thing all the way up, right? So this is one example. Let me go to the next example. So here we see the same thing happening. We have our Asian range here, like this, with this mini consolidation here. So what happens? The market takes out the breakout traders, people that trade breakouts buy here. Market goes, hits their stop loss, goes back up, breaks above the Asian range, stop on, takes out the liquidity above, right? So the market gives you this M formation like this. Then what happens? The market goes and breaks the neckline. And once it breaks the neckline, you draw your box. You can draw your box like this, or you can draw your box from this one, like this, right? If you want it to be more refined, you can draw it from here like this, from the middle. So now what happens? The market goes down, breaks the neckline and goes back up, rejects. You can see this rejection here. If you want an aggressive entry, you can enter on the close of this blue candle. But if you are more conservative, you can wait for a red candle. And once you see the red candle, this red candle here, you can enter. But the problem with this trade is the red candle is too big. This candle, the distance from here to here is too much. If you're going to enter here, your stop loss is going to be massive, right? So you can't enter there. Maybe you can enter here on the second leg of this M like this. All right, so maybe you can put your stop loss here and then take this all the way down and eat this. All right, so let's go to the next example. Here we have the same thing, right? So you can see that we're just trading patterns, right, that repeat themselves over and over again. So here we have our Asian range, right? Market breaks to the upside, takes out the liquidity, breaks to the downside, takes out the liquidity, gives you this W formation. This is your neckline of the W formation. What happens? The market closes above, breaks it. This is your zone, your liquidity zone, right? So what happens? The market goes down, comes back and retests it twice, here and here, right? So you can enter anywhere in here is a good entry, right? So anywhere in here is a good entry. If you entered here, you can put your stop loss here or below here or below here, all right? And then write this all the way up. Let's go to the next example. Here we have something similar. We have our Asian range, very tight Asian range, about 14 pips, all right? The market breaks to the upside, takes out the liquidity, breaks to the downside, takes out the liquidity, gives you this W formation like this, right? So what then happens? You draw your box across your neckline, right? So you can draw a box like this, or you can refine your box maybe like this, from here to here like this, right? The market goes back, retest the neckline, goes down like this and goes back up. You can enter here. You can enter here. This will be an aggressive entry. You can enter once the market goes back up like this. Put your stop loss here, put your stop loss here, 10 pips below, and then ride this all the way up, right? So here's a very beautiful example. I love this one. We have our Asian range consolidation here, right? Liquidity is above, liquidity is below. The market goes up, takes out the liquidity, gives you this M formation here. So this is your neckline. Draw your box like this. The market goes back, tests this, we test this box twice. So we have one retest here and we have one retest here. So that's two retests. So the market gives you two opportunities to enter here, which is also an M formation like this, right? So you can enter here on the close of this candle. This is an engulfing candle, right? So you can enter on the close of that candle, or if you entered here, this would have been fine. This would have been fine as long as your stop loss is above here, you're safe. So if you entered here too, your stop loss can be above here, and then you can take this down like this. This is another example. Here we have the same exact thing over and over again, day in and day out. So we have our Asian range, right? We have our stop hunt to the highs. Market goes down. This is your M formation like this. Right, this is a bit sloppy. It's a really sloppy M, but it's still an M, right? So this is your first leg, this is your second leg. You can see that the market came back. Remember I told you that there are different variations of the M and W. We have M's like this, right? So this is an example of that. So the market comes back in. This is your neckline, draw your box like this. The market goes down, comes back to retest that box. You can enter here or you can enter here. All right, put your stop loss above, take this down, how many pips it goes. So if you found this video helpful, subscribe, hit the like button, and also if you want to join my free Telegram, the link is in the description below, and I'll see you guys in the next one. Peace.